Welcome to Markets Today. I'm your host, Bithe Mwema. Today, we have the privilege of being outside of our location and being able to record on-site while still adhering to the social distancing COVID-19 rules. We are in the Stanbic offices, the head office in Nairobi, and we're having a one-on-one interview with Abraham Ongege. Abraham is the Chief Finance Officer. This interview is on the back lines of the first quarter announcements that came from the bank, the earnings results for first quarter 2020. We want to delve into the numbers as well as understand the bank's outlook in as far as COVID-19 is concerned, as well as its mitigating measures that it has taken to actually extend the measures to its current client base as well as to the economy. Welcome to the show, Abraham.
Thank you for having me, Mbide.
What does COVID-19 mean for you as a bank manager at Stanbic Bank?
COVID-19 has actually created a different set on how we lead as leaders of Stanbic. I think our first priority as a bank was to say we need our customers to be safe, we need our staff to be safe. And a lot of changes have happened in how we then work going forward. 47% of our staff are now working from home. And we've also created various measures within our branches to ensure that our customers remain quite safe. So it's a new meaning, and it's created a little bit more opportunities on how we think about digitization and innovation within the way we work.
Okay. I must congratulate the bank. Immediately COVID came out and the central bank extended measures, or rather guiding measures, to the banks to help their customers mitigate the impact. Stanbic Bank was actually the first to come to the market and sort of just pass across a couple of measures. Perhaps you can walk us through these measures and what they have meant for the performance of the bank? Yes,
we did realize that the measures to contain the pandemic then were quite severe in a way, and were at a shock to some of our clients. So we immediately offered our clients payment holidays to enable them adjust and rethink about their business models. So far, we've restructured about 30 billion of loans, which amounts to about 19% of our loan book. And this has gone through both retail businesses and corporate businesses. Our SME businesses have benefited by about 2.3 billion of loans restructured. We do continue to monitor the impact of COVID-19 for our customers, and we continue to engage them. And should any of them require any form of modification, we are happy to accommodate them.
Okay. I think today is the 75th day since Kenya got into the COVID mode, and the central bank was working with a 90-day period of allowing for adjustments. Do you still see a situation where Stanbic Bank continues to extend this holiday on debt to its customers once the 90 days lapse?
I have to say there are pockets of adjustments that we've seen for some of our clients, and some of our clients are starting to adopt to the new normal. So a lot of our clients will go back and start opening up their businesses. We do see the government coming up with a stimulus package, which, when effected, will try and assist some of the SMEs access credit and some of the businesses to go back to the new normal. Okay. But we also do realize that some customers will still continue to see some level of stress, and we are happy to accommodate those customers.
Okay, so you sound very optimistic. Are you concerned about COVID? Is it going to have a lag effect on the economy and the financial performance of your bank as a key institution in this country?
The reality of COVID-19 is that it has now moved from the notion of a pandemic to now an endemic, which effectively means that it is something that we will continue to be with, and we do need to manage going forward. We as Stanbic choose to rebound to this endemic and keep Kenya moving. And that's why we maintain a notion that we will continue to support our customers, and we will continue to think differently around how banks grow. So I'm optimistic by the fact that Kenyans are resilient, and Kenya will come out of this stronger.
I absolutely concur with you. The keyword resilience is something that we keep seeing in as much as different cycles or different disasters hit the economy. Let's look at the earnings that you reported recently. There was there was a drop, about 33.5% drop in earnings comparing first quarter 2020 to first quarter 2019. Kindly walk us through the quality of earnings and what was happening here.
Yeah, it is important to reflect on these earnings and also look at that from a run rate perspective. If you look at the first quarter, we are almost going on a run rate of a flat year-on-year performance. But having said that, we are moving into a rebound, having come out of a little bit of pressures in the first quarter as a result of the manifestation of COVID-19. There are definitely a couple of one-offs in the first quarter of 2019, key significant deals that we booked in the first quarter of 2019, which did not recur in 2020. However, we've seen pressure around margin compression with the reduction of the central bank rate, which we then passed that benefit to our customers. And we've also seen that in order to support our customers during this season, that we have waived all our mobile banking transaction fees, which has some slight impact on the effect on our earnings. We've taken a prudent view on credit provisioning in the first quarter of the year, and we continue to assess the level of this provisioning going forward.
Okay, so if I look at it on a normalized basis, would you say these results were more or less in line with last year, excluding the one-off numbers?
Yeah,
Okay.
Largely yes.
All right, and you bring out a very interesting element in as far as fees and commissions are concerned. We did see the central bank pass out a measure that would actually allow for the waiver of the transaction fees from bank to M-Pesa. Has this had an impact on your own fees and income earned over the period?
Yeah, I mean, if you kind of reflect that both telcos and banks actually collaborated in ensuring that transactional fees for whether you transact in a telco in a telco platform or a bank platform, that as a customer you don't find any difference. And this collaboration has assisted us in kind of enabling our customers to transact in the mode with which they prefer. So I actually do not think that it has caused a shift. In fact, our mobile banking transactions increased by about 50% during the period of March 2020.
Okay. Are you able to share with that a sense or an average in terms of the loss of revenue? Because earlier, I think last month, Safaricom did announce its numbers and it intimated to the market that it was losing about 650 million in terms of loss of revenue from these adjustments. Is there something that you can share with us in terms of the possible loss of revenue that has been caused by this in as far as Stanbic numbers are concerned?
Yeah, it's a little bit of a complex one. I think if you just look at pure numbers in terms of fee collected, you're probably looking at about 20 million in a month. Mm-hmm. But then you also have to take into account that a lot of your customers, because of the need to transact, they're keeping more balances with you, which has an effect of kind of offsetting some of the impacts around the direct fee and commission that we do suffer.
Okay. And is this something temporary, or do you possibly think it could be the new norm? And of course, I don't want you to speak on behalf of the central bank governor, but in your circles, in your networks, in the decision spaces that you're in, could this be the new norm, or is this temporary? And do we go back to the earnings of that we were seeing before coming from the mobile networks?
Yeah. Eventually, banks would have to take commercial decisions around whether to proceed and continue to offer these services free or at a reduced rate. So I see a competitive force kind of influencing whether this would become a new normal or not. But we have to recall that banks have traditionally invested heavily on their mobile banking platforms, and in a way or another, with increased utilization, you then reduce the cost to serve in other channels, and therefore it's something that we could be able to absorb.
All right, fantastic. And what about margins? What has changed this year compared to last year? What should we expect for the remainder of the year?
Yeah, we have seen the central bank rate reducing, and with the lifting of the interest rate capping law in the tail end of 2019, all existing loans continued to remain pegged to the central bank rate, and therefore the benefit of the reduction of the central bank rate then reflects to the margin, and it's a benefit to the customer. I think in this period there is some element of the need to keep rates low in order to boost credit growth. So we do expect that we will continue to offer our customers affordable credit, especially to help them rebound within this COVID-19 period.
Okay, fair enough. Then let us get into the balance sheet and look at the growth there. We did see growth in deposits, marginal growth in loans, some growth in your exposure in government securities. Walk us through the tenets of your balance sheet.
Yeah, I mean, the pleasing thing around our balance sheet is that it did demonstrate growth. So it did demonstrate that we are keeping Kenya moving by continuing to grow our deposits, by continuing to partner with our customers and offering lending. We do appreciate that in some instances, some of this growth is slow given the uncertainties we see within the COVID period, but we would like to partner with the entire Kenya society to kind of boost growth. So we are open for business, and we saw areas where customers kind of hesitated in some of their decisions to borrow, but we are seeing some rebound with some of the European markets opening up, and trade is starting to coming up slowly.
Okay, but there's a cost to this growth and this optimism because we have seen a jump in the gross non-performing loans. Where are these non-performing loans coming from, maybe in terms of sectors, and what's the number that is currently sitting on your books today?
Yeah, we do have some historical non-performing loans which we continue to partner with customers to kind of resolve the areas of distress, but we are also taking a cautious view around the effect of this pandemic in some of our customers who may continue to be in distress for a longer period than we had expected. So we have seen stresses in a portion of the agricultural sector, especially the sector that then relies on exports to grow their revenue. We have seen some stresses in the manufacturing sector, which we are trying to resolve, and some of them were on the tail end of resolution. Now, within the personal and business banking space, there are a couple of stresses in the real estate sector, quite slow in terms of new houses and people buying new houses, causing a little bit of distress.
Okay. In terms of opportunities that you're seeing emerging as a consequence of COVID, are you seeing loan applications or demand from loans from particular sectors that were not emergent before COVID?
Yeah, there are a couple of winners and there are a couple of highlights that we've seen. The area of e-commerce presents a huge opportunity. The area of assisting businesses to digitize some of their operations by use of investing in robotics and artificial intelligence is quite an opportunity. Agriculture still remains key, of course, with understanding the other areas of stresses such as the locust invasion and the floods. It is important to realize that agriculture will continue to play a very big contribution to our country's GDP. Mm-hmm. So there are definitely areas where we are seeing winners. Of course, telcos continue to be winners in this period.
Okay, certainly. But on agriculture, are there certain spaces that look more profitable than others? Because, I mean, agriculture is a broad term, and there are some people who lose money, there are some who make money. And there are some areas that are worth investigating if somebody was trying to get into agriculture or to evaluate opportunities there.
Yeah, certainly the areas that assist us continue to have food security are definite opportunity areas. So the grain area continues to be an opportunity. The areas around animal farming continues to be an opportunity for us. There are areas where they would need to rebound, and floriculture is one area where we would want to see some rebound, especially if the European markets open and exports resume.
Okay, Ephraim, let's just take a short break. Join us as we come back to just conclude this conversation, looking at the outlook for these numbers as well as the possible impact the economy will have on the bank's earnings. We'll see you shortly.